QuickBooks Pro Desktop 2021. Fixed Asset Items Overview. Let's get into it with Intuit. QuickBooks Pro Desktop 2021. Here we are in a QuickBooks practice file. We will set up another practice file from scratch to practice recording fixed assets, recording fixed asset items, and looking at the item list to see the benefits of the use of the item list. But first, we want to think of an overview of the fixed assets, what the fixed assets are, and then how the item lists and the items themselves can help solve some problems related to the fixed assets and recording the fixed assets. So first, let's think about what the fixed assets are. If we think about the item lists and the items for the fixed assets, they are there to support, like many other reports, some item on the major financial statements, that being the balance sheet and income statement, primarily the balance sheet. So let's open up the balance sheet first, go into the reports dropdown, company and financial. We'll take a look at the balance sheet standard. Balance sheet standard, I'm going to change the date up top to 12/31/20. Now on the balance sheet, when we think about the fixed assets, they could be called property, plant, and equipment, PP&E, depreciable assets, all different names for the same thing. And the thing with these large type of purchases, you can think of them as things that are going to be large purchases. More technically, you want to think of them as things that will be impacting or affecting revenue generation, not just in the year of purchase, but also in future years. And therefore, on an accrual basis, we'd have to put them on the books as an asset and then expense them or allocate the cost over the years that will actually be used in order to generate revenue. Now, you might say, well, I'm a cash basis person and I don't want to go on an accrual basis. I'm just going to expense it when I purchase it. I'll just pay cash. I'll expense it at that point. You still can't really do that even if we're in a cash basis system. Why? Because when you do your tax returns, you're still going to have to put, even if you're a cash basis taxpayer, because these are such large items, the IRS will force you to put them on the books as an asset, and then use depreciation expense as the expense of allocating the cost of the purchase, not just in the year of purchase, but in the year of benefit over the useful life of the assets. So we're basically forced to deviate, even if using a cash basis, to an accrual basis when we purchase large things, large equipment, whether we've paid cash for it or we financed it. We're going to have to put it on the books as an asset and then allocate the cost over the time period that it will be used. Now, the other kind of issue with the property, plant, and equipment is that it's not something we do all the time, meaning we're not going to buy like a forklift every day or something like that, or a truck, or large equipment items. So if I look at the home page over here, then there's no actual flow and there's no actual form that is set up specifically for the purchase of equipment, because it's not something that happens on a day-to-day basis. It's an unusual thing. We're planning for equipment. There's going to be much fewer purchases and sales of equipment than, say, sales of other types of things like invoices and sales receipts and whatnot. So because it's a less usual transaction, then it's going to be a little bit more difficult because it's not something that we've set up a systematic routine around. So if I go back to the balance sheet, then we can think about, okay, what are going to be some of the problems with the fixed assets then? Well, if I put it on the books as an asset, the purchase isn't that difficult. I can, instead of recording an expense, I'm just going to record it as an asset. I might have to finance it, which might cause a little bit of trouble in terms of how I purchased it, because I have a loan related to it as well, but still not too difficult to put it on the books as an asset instead of an expense when purchased. The problem is going to come into place, of course, when we calculate the depreciation, because that's going to be a little bit confusing. I got to do another step. I don't have to do that if I just expensed it, right? Now I've got to think about, well, how much do I expense per year, per month, and how am I going to calculate that? Is it a straight line method? Is it a double declining method? And it could have a different method if I'm on a book basis versus a tax basis. So the calculation of depreciation is often going to be a complex component. And oftentimes, the software of QuickBooks isn't really designed to calculate the depreciation using multiple different methods. What is designed to do that? Typically tax software. Why would tax software be the place to go to calculate the depreciation? Because the tax code is very specific on tax depreciation, meaning you have to do it for tax depreciation using tax software. So if that's the case, then you might as well basically use that software to calculate book depreciation as well if it has the capability to do so. Small companies might just simply use tax depreciation, even though it's not ideal for bookkeeping purposes, because they don't then have to track two sets of books for two different depreciation schedules. So that's one kind of issue. So really, if you're thinking about, how is the depreciation going to be calculated? Well, oftentimes many, small to mid-sized companies are basically going to be reliant oftentimes on the tax preparer, on the CPA firm, on tax software other than QuickBooks to actually do the calculation of at least the tax depreciation, and most likely often, if they separate, the book depreciation as well. So let's imagine that's the case. Now we're going to say, okay, now the tax person is going to be basically calculating the depreciation. I'm just going to record the depreciation into the books as an asset here. So what do I need to do in order to make that happen? Well, that means the tax people are going to have to provide you with the depreciation schedules, which might look something like this, right? They can provide you with depreciation schedules so that you can then periodically record the depreciation, either monthly or yearly, based on the information that's provided not from QuickBooks to calculate the depreciation amount, but from some other software oftentimes. So you'll just take that adjustment, and then you'll just record it in your system. We'll record it in our system periodically at the end of the month or the end of the year, and that'll be nice and easy. I just record my assets, I let them increase here instead of expensing them, and then I'm just going to do an adjustment periodically, debiting depreciation expense, crediting accumulated depreciation based on the detailed information that's provided to me by my tax preparer, who can provide me that depreciation either on a tax basis or book basis, whichever I prefer. So that would be great. So now we can do that. Well, what does the tax preparer need in order to do the depreciation? They need more than just this one number, right? Because they're going to need all the depreciable assets that we have in order to calculate the depreciation. Now, if you did the tax return last year and all of your depreciable assets were already in the system, meaning we calculated depreciation last year, and now we're doing it this year, well, then all they need to know is what items we purchased and what items we sold this year. And there shouldn't be a whole lot of them because these are large depreciable assets. So that we need a list then to give them, and we need to make that list individual assets. I need to support this number then with individual items, and I need them to be individualized, because if I sell a particular item, I want to know which item I sold. If I group everything together in one lump sum number, then I'm going to have a problem if I sell or dispose of things. And that's really where this list comes in fixed asset items. So if I was to think about that, then I can say, okay, well, how can I track that in QuickBooks? I want to track the things that I purchase. When I purchase things, if I double click on this fixed asset item here, and I go 010120, then I see my purchase right there, and that gives me some detail, but it might not give me all the detail. All this is going to tell me possibly is that I paid somebody that amount of money, and possibly I financed some of it too. So maybe I don't know all the details on this transaction here. So what we want to do then is also list it out some other place, and QuickBooks gives you a nice place to list it out, and that's going to be the fixed asset items. So then you can go to the lists drop down, and we could say I want a fixed asset item list right here. And this will give us a list of the things that we're going to be purchasing. And it'll give us all the detailed information that we need. So anytime we purchase something that we're going to record as a fixed asset, we probably want to go in here as well and then provide this information into here, so that we then have all the information we need to provide to the tax preparer at the end of the year, so that they can enter the data not just as one $20,000 item possibly, but have all the detail of that $20,000 item. And if it was more than one thing that we purchased, we can list out the multiple things that were purchased and provide that to them. So if I was to double click on an item, then we have the description of the item, and then we have the date of purchase, the cost of it, possibly the vendor, and then we have any more detailed information down here, which could include things like the serial number and whatnot, and any further notes that would then be necessary. We can also track then when it is sold. That's what there is going to need for tax preparation and the calculation of the depreciation schedule. And so if I close this back out, if I look at this list, then notice that I can also run a report on it. I can run the reports down here, and I know this is a short list, but we'll put one together in a second. If we go run a report and say that we want the fixed asset list, then it's going to list the fixed assets here that we have, and here's the account that they're going to be going to: auto and furniture and fixture. Now, if we were to add these two up, the 20,000 and the 23,000 add up to 43,000. And if I go back to my balance sheet, it should tie out to this number right here. It doesn't. And I would bet you that I've seen many QuickBooks companies aren't properly doing their fixed asset list, and maybe they don't need to because it might be something that's helped to do outside, but it's something that can track your current activity that can help you to provide that to the tax preparer. So right here, then it should tie out to the cost here. Notice what it's not doing. It's not tracking the accumulated depreciation. Now, I purposely did not tie it out to the cost because note, there's nothing forcing us to tie it out to the cost, meaning unlike like a subsidiary ledger for accounts receivable, which does force you to tie it out, QuickBooks basically makes this tie out to the subsidiary ledger, breaking this out by customer. The fixed asset list does not. It does not have any control. It does not have any like internal control. It's basically tying it out. You're entering it in two separate spots, meaning in order to enter a fixed asset, what you want to do is anytime you record something to a fixed asset, I'm going to say 010120, we got to do the actual transaction, recording the 20,000 here, and go to the fixed asset list and add the item to the list. And that way, when I provide the detail to the tax preparer at the end of the year, I can provide this information. So most companies, and I would say at this point, they may not have this number tying into their fixed asset list. Now you could go in there and adjust it quite easily by taking the prior depreciation schedules, possibly from the tax return, and entering it in. You're looking at the cost line, not really the accumulated depreciation, and then you'd enter in everything from the past, and you could basically work to tie everything out. But even if it doesn't tie out, your major goal is to look at the changes, the new activities. So what you want to do going forward is when you use the list to then provide to your tax preparer at the end of the year, you want to look at the changes, the activity. If I go into the activity for the year here, and I was to say January 1st, 010120 to 12/31, I want to have the backup supporting list for all the activity, all the change, because the tax preparer already has the information prior to that from the prior year. They need to know the increases and decreases in the current year, and the list can then provide that. So if your list doesn't tie out to the cost right now, you can fix it. You could tie it out. And also note that even if it doesn't and you're moving forward, the list can still add value. The value it will add is by tying out to the change, that you tying out to the new things that are happening, so that you can then provide that list to your tax preparer and make the data input for the new purchases as well as any disposals as easy as possible. So that's going to be kind of like the idea of this. Now to set this up then, what I would do is, if you're starting a company from scratch, is first think about what's the grouping of your fixed assets here. So for example, tax software will often group your fixed assets in terms of automobiles and transportation equipment, furniture and fixture, machinery and equipment, building, improvement, and land. I would match that because that's going to be what your tax software will look like. So talk to your CPA firm or your accounting firm, and if you're doing your depreciation there, what are the major categories that are going to be in their tax software? And then line up your categories to match to make it as easy as possible. And then so when we set up our books, what we'll do, if we're setting up from scratch, is I'll go to my lists up top, we'll go to our chart of accounts, and within our fixed assets here, down here, all these fixed assets, I'm going to start to line them up. I'm going to change the names to line up to the major groupings that would tie into the outside schedule that's going to be used, so that when I add a fixed asset, it's going to be in the same type of grouping as will be lined up on the software that's going to be helping to calculate the depreciation both on a tax and depreciation method. So we will do that, and then we'll set up an accumulated depreciation and think about how we're going to fit that in. And then as I add new lists to my lists for the fixed asset lists, I can then add them to those categories and then add the more detail for them, so that the tax preparer can then use them to line up. And then when they give me the adjusting entries for depreciation periodically, those will fit in nicely to the groupings that are in both software. So that's an overview of what we'll do. We'll talk about how to kind of set that up in future presentations.